Hey, what's up guys, Austin Schneider here, and today we're going to give you a breakdown of the 5 main loan types, which are conventional, FHA, VA, USDA, and jumbo. So if you're in the market to purchase a house, you may be overwhelmed by the different types of loan programs. So in this video, we're going to break down each one step by step so you have a clear understanding and potentially know a good route for you to go as a home buyer. First loan program that we're going to talk about is the conventional loan. So the conventional loan works best for people with good credit, solid employment history, and at least 3% down. Since these loan programs are a little bit more strict than others, when it comes to credit score, you should at least have a 680 if you are considering a conventional. And when it comes to employment, you'll want to have a solid 2 years of employment history. The conventional loans are pretty strict when it comes to this. If it's something that you don't have, you might want to consider an FHA. And when it comes to down payments with the conventional, 20% is going to be your best option because you're going to avoid the private mortgage insurance, which would save you a couple $100s per month. Conventional is typically, best if you have more than 5% to put to the table as a down payment. If anything below that, you might want to consider an FHA or a different loan type, just because the lower the down payment, the higher the interest rate for you as a borrower. All in all, conventional loans are a great loan program if you have a solid financial history and credit score and good amount of down payment to put down to the table. But if this isn't the case for you, you might want to consider what's called an FHA. The second loan type that we're going to talk about is the FHA. So the FHA is a great loan program with flexible credit guidelines. The minimum credit score for this is 620. Some lenders even allow a 580 credit score. When it comes to down payment, you'll just need to bring 3.5% to the table, which can be a gift from a family member or another eligible source. FHA is also very lenient when it comes to your income. Even if you're a seasonal employee or if you haven't had that 2-year track record like you need with a conventional loan, you still may be able to qualify when it comes to an FHA loan. And the reason for this is because FHA loans are designed to help applicants that normally wouldn't be able to qualify for a conventional loan and want to make home ownership in reach for you. One thing to note when it comes to an FHA loan is you will be paying mortgage insurance. Mortgage insurance can be around $175 on a $250,000 loan, but it can be worth it if this is the only route you can go for home ownership. Let's take a quick look at an example with a home buyer with a 660 credit score on a $250,000 house with an FHA loan. So with 3% down using a conventional loan, that would cost around $1,650 a month at the current rates. The same home with an FHA loan and a 3.5% down would be around $1,550 per month, a savings around $100. Most people assume that FHA is more expensive, but that's not the case for those with a small down payment and lower credit. That's because conventional loans charge higher rates and mortgage insurance costs in this scenario. As a home borrower, it's definitely worth checking into an FHA loan and comparing situations, even if you do qualify for the conventional loan, to see where you will have the best scenario, best savings for you as a home buyer. The third loan option that we're going to talk about is what's called the VA loan. Guys, if you're an active or former military member, this is an awesome option for you to take advantage of if you are in the market to purchase a home. With the VA loan, there is no mortgage insurance and there is no down payment required from you as a borrower. Let's look at an example on a $250,000 house comparing a conventional to a VA. On a $250,000 home purchase using a conventional loan, if you put 5% down, which is $12,500, you would be also paying mortgage insurance, which is around $180 per month. This would make your total payment with taxes and insurance about $1,550. Now, let's look at a VA loan. So with a VA loan, your down payment would be $0. And when it comes to mortgage insurance, it would also be $0. Plus, with a VA loan, you'll probably get around 0.25% lower of an interest rate because VA rates are traditionally lower than the conventional rates. This would make your total payment at $1,420 a month, a savings of $130 a month compared to conventional. When it comes to income and your credit score with a VA loan, there's also a lot of flexibility there. The minimum credit score required for a VA loan is usually 620, making homeownership that much more accessible for you. To qualify for a VA loan, you must be an active military member or have served for at least 2 years and have been honorably discharged. Guys, VA loans are a great option for you if you meet the qualifications. The fourth loan program that we're going to be talking about is what's called a USDA loan. Guys, USDA loans are the best kept secret when it comes to home buying. There's flexible credit guidelines, rates are extremely low, and you'll be putting 0% down when it comes to your down payment. When it comes to mortgage insurance, it is also more affordable than the FHA, making homeownership that much more accessible with the USDA. Let's look at an example here. So an FHA loan for a $250,000 home with 3.5% down would be around $1,550 per month. The same home with USDA would require 0 down. In addition, the monthly payment is around $1,500 a month. So even though you're putting less down with the USDA loan, your payments would still be cheaper. This is because USDA loan mortgage insurance fees are lower than the FHA mortgage insurance fees. The only catch with the USDA loan is that the home must be in a USDA eligible area. Some people think this is in a very remote location, but a lot of times it's just outside of the city core. So if you are looking for a house in a rural or suburban area, definitely consider a USDA loan. Definitely check out a USDA loan to see if that would meet your needs, as this can save you a lot of money compared to other loan programs. And the last loan program that we're going to talk about is what's called a jumbo loan. You might consider a jumbo loan if your loan amount is going to exceed the conventional loan limit. Typically, this is around the $500,000 mark. In many larger cities like Washington, D.C., Seattle, San Francisco, jumbo loans are very popular because home prices are so high. The good news about jumbo loans is that they're widely available from your mortgage lender or from your bank. When it comes to jumbo loans, rates are generally lower than other loan programs will offer. This is because the banks are making their own rules when it comes to the jumbo loans, and they want to earn your business. You will need good credit when it comes to a jumbo loan and around the 10 to 20% down mark. All in all, guys, if you are in the market for purchasing a home, don't just think that you need one loan program. It's definitely worth it to check out multiple as you are venturing into your home search. For more about this topic, for more on the different types of loan programs, visit us online at themortgagereports.com. Thanks so much for watching. We'll see you on the next one.